Busy week this week. Lots of stuff on Twitter. Lots of stuff going on in the markets. The counter trend negative performance continued a little bit, I think, um, this week, and that December needs to pick it up starting next week. A little reversal in those. Yeah, reversal. I hate it when these people call the lows in the bonds and get it right. There we sit with our shorts. Everyone in the world knows they're going to rally except for us. Well, we can't do anything minimally. We may think or know, but we're just going to sit there with our systems and watch watch and see what happens. Oh yeah, I wanted to also talk about today. I had a lot of things bookmarked. I like this bookmark thing because I see tweets out there that I don't like or that are negative, and I just bookmark them so I don't have to like them, but I can come back to them and give them their due later on Spaces. And yeah, I tweeted something about sugar and volatility targeting, volatility management. So I got some pushback on that. So that'd be a good thing to talk about this morning. Oleg.
Be having a bit of trouble with Oleg. I saw two Olegs up there for a while, Jerry.
Well, how much fun would that be, having two Olegs? My God, that would be amazing. Double the fun. Now, if we got two Richards, that would be a little overwhelming, I would think.
Don't be nasty.
Yeah, I didn't meet Mrs. Brennan when we were in Australia, but I bet you she would have a few things to say about dealing with two Richards. I know Lisa would. She would.
That's why I'd never release her in public, Jerry.
That's right. That's right. Okay, so anyways, Oleg's not with us yet, but he will let us know when he is ready. And so, yeah, I posted this tweet this week about sugar. And sugar had a massive, I mean, I don't know if I've ever seen a sugar move like this before. It was a pretty massive sell-off, and I blamed it on dynamic position sizing, volatility management, managed future CTAs who are reducing risk so they can, so they say, and they create this enhanced volatility, the burst of volatility, which triggers this indiscriminate selling. Back when I first started getting into volatility, trashing vol management, I read something about indiscriminate selling from someone in the midst of one of these massive stock sell-offs, no doubt. And I was just racking my brain the other day when I was posting this tweet to remember what was that term I used, indiscriminate selling. And I think that's kind of one of the issues. If you're going to go in and at billions of dollars under management, multiple people, you got to go slow in sugar. Just take your time and piece it in, 5 lots at a time or something. Use your algos. But this thing sold off like crazy. So it reminded me, and I got confused a couple of days later because I thought, was it cocoa or sugar? But it definitely reminded me of cocoa a few months ago when cocoa had a similar crash and then it came back to new highs. So, and then Michael said that I had missed out on the true facts, which were some fundamental news. But I Googled this fundamental news and that had happened about a week prior to this sell-off. So I'm not really sure. So I'm going to stick by my complaint that we just, this vol management, vol targeting is just a little indiscriminate with their order placement and how they just screw the market so bad in order to supposedly reduce their risk, which creates more risk, more selling, until I guess it kind of stops. But sometimes, it works and it's right. And hopefully most of the time it's not so devastating and dramatic. I wanted to also, so there's a lot of comments down there. One was, I'm scapegoating. I don't think I'm scapegoating. I don't know if it's actually true. And I really felt bad when Michael said that there was some fundamental news out there that I had missed. But I'm not sure that's the case. What evidence is there that CTAs are causing the drop? Well, one of the evidences we have is they talk about it a lot. This is their whole thing. So the vol is rising in a big trend like this. They damn well better be out there selling it when the vol keeps rising, because that's what they promised everyone that they're going to do. So I don't know if they're selling it or not, but it would certainly fit if they don't, they have some explaining to do. So I think, more than likely, this sort of massive selling, one of my other complaints I have is that when, someone else said, I'm blaming my recent poor performance on those who have done better. Okay, come on. Sugar's going down. We don't have to drag in my bad performance, my relatively bad performance. Yeah. Anyways, Oleg, are you ready? No, maybe. Let's see. But I'm going to keep watching this sugar. We'll see. We'll see what happens. It's such a shame to sit with the trade for so long and then have this massive one-day crash when everyone's just trying to sell and readjust their positions. And then after that day, they got to sell more. They screwed up the vol. They've got to sell more. It's just such a shame to see this. Managed future CTAs don't want to trade trend following. They want to screw around with it, mess it up, and now they're trying to ruin it. Jerry's not liking it at all. Really, no fun.
Really happy that I had a little program issue in the beginning of our conversation, so it happens. So I want to say that I'm very happy to be here as always. It's my tradition to say these words. And I was very impressed by the Algorithmic Advantage podcast number 009, number 9, because I saw very beautiful Australian nature. I saw I saw all what I love. I saw all what I love there. And also I saw Ukrainian flag, and I love this flag, and I love Ukrainian country. So all what I love. And so it was very wonderful conversation. Very wonderful conversation, and of course I did my notes and I published my notes. And for example, I want to read a note from Moritz, and he said very good thing that so. As a human being, you look at the charts, the bonds, or some of the commodities, or Eli Lilly, but probably just by visualizing that thing, you would go like, it's gone too far. It has simply gone too far and needs to stop. And you would say this with OJ when I traded and 250. And I fully agree with this. That's our human emotions, our logic, our maybe what we call an intuition. It's all against us in our trading activity, because really we as a human beings, we look at the charts and think that this trend can be stopped and can be reversal, and it's right time maybe to stop the trade, but if you do so, you will be in a losing situation. It's really, we must teach ourselves to be, as I always say, to feel comfort in uncomfortable, to most people, circumstances. We must feel to be comfort. And so it's very important to understand. Jerry always said this. And when we do something discretion, maybe it's a step not in the direction of not being a trader at all. I think so. Because in every discretion, it can ruin everything. For example, if we, and I have said this before, if we drive a car in a discretion way without any rules, maybe you will like it for a few days or a few weeks, but at the end of the day, it will lead to a car accident. And I think, and I'm sure, and if you do discretion things in your trading, it will lead to something bad. And of course, Moritz and Jerry and Richard, they say very right things. And do the right thing, do the hard thing, do the right thing. It's Jerry's words, and I love these words. So let's get started. Again, very happy to be here. And I was waiting our discussion, as always, all week, every day.
Thank you, Oleg. Richard.
G'day, Oleg. G'day, everybody. Look, I've been smacked in the chops this week with all of my trends. So some of the significant trends I've been writing all reversed this week. So, I came out of November feeling quite cocky because I didn't have much bond exposure in my portfolio, and I came out ahead for November when, the CTA crowd in general sort of had a pretty bleak month for November, but so I came out fairly cocky, but then I was absolutely slapped in the chops this week with major reversals in my London sugar, my orange juice, and a lot of the currencies as well. So there's something going on. I haven't had a chance really to look at what's driving it, but I can certainly see it in my charts. And yeah, it's been a tough week for me. So hopefully, as December sort of draws to a close, there's a bit of a return back. So I'm still in quite a few of these positions, of course, but a lot of that unrealized equity's been chopped off at the knees, as we often experience. But yeah, that's me in a nutshell, Jerry. It's very hot over here in Australia. You're lucky you came over when you did, because it's really heated up since you left, and it's blistering at the moment.
Well, Florida's pretty cold where I am. So yeah, we had a great weather there. It was not too hot, not too cold. It was just perfect for us. Yeah, the yen. Oh my, the yen was quite a mover yesterday, I suppose. And then I'm heavily involved in all the crosses: Euro yen, Swiss yen, Canada yen, Aussie yen, New Zealand yen.
Join the club, Jerry. They've been hammered.
Right. Yeah. So we don't need the yen to rally here at the end of the year. But anyways, such is life. And the one thing is you can't predict these markets, and we can hang up. I've hung in here on so many trades this year that we got some temporary counter trend, and it went right back to trending. And then I got stuck on some that was not temporary, and I got run out of my position. Then I had to get back in later. So it's just all over the place. Anything bad or good that you can think of is probably going to happen at some point in your account. There's another tweet here I liked that Seth sent out, I think, yesterday. I like this tweet, and I didn't get a chance to get Seth on to comment on my new idea of creating about 10% of my portfolio is now crypto stocks, crypto futures. And Alp just said that all my stocks are really just stocks, not crypto stocks. Or not, yeah, that's a little game I play. The crypto stocks are in the crypto section, not in the stock section. But so I think Bitcoin rally, that's been a fun, hopefully that'll keep going, and it'll be a worthwhile trend for us. Oh yeah, so this is another issue that Seth brought up yesterday that we've talked about before. I like this issue. It is, should trend following traders out short trades when the risk return is limited by the zero bound? Is crude oil in 2020 trading negative the exception, or the proof filtering reduces robustness? If you decide to filter out shorts with limited profit potential, how do you do it? I think this is a good topic. I like this topic. I like to filter out shorts. Obviously on some shorts, if they have, if you go short and the potential profit to zero is just a few ATRs, obviously you probably don't want to do that trade if your max loss in ATRs is greater than your max profit. And the thing about that negative crude, that was a good trade if you got out when it was negative. And I'm not denouncing that trade as something to take into consideration, of course, but it's not a good idea. It's not a good evidence because even as the trade started approaching zero potential more profit or really small amounts of profit left, it's not like the trend follower is going to get out near those lows anyways, because we're going to wait for a rally. But if you just go in and throw in that, if it gets to a certain level, I'm just going to get out, then that's probably further down the road of lacking robustness. And then I think that what has happened to me in the past is that when I have filtered out short trades because of their lack of potential profit, I've had a couple of times that it's a very painful situation because none of those trades obviously turned into outliers, so that really wasn't the issue. However, there was a whole group of trades, like a lot of commodities that I avoided, but in a small amount of time, like a month or so, they all had like nice 4 or 5 ATR moves. And so the accumulated profit in all of those trades was really, relatively speaking, was very uncomfortable. Like CTAs were making 5% for the month, and I was unchanged because they had a lot of these small temporary winning trades on, which the next month or so, they all kind of rallied, and it turned out not to be very good trades, of course. But over a short period of time, your relative performance can really stink if you avoid some of these short trades with a lack of potential profit. In my mind, too, the robustness is not really an issue as it relates to this because it's a rule and that says, like, don't take the short if it doesn't have a certain amount of potential profit in it. And so when you overlay that into your system, you do reduce the number of short trades in your sample size, but not to some sort of, at least not for me, because I didn't try to get rid of all the shorts, just a handful of obviously really limited potential. And so you apply the rule, and then you come up with, instead of 1,000 trades, maybe 900 trades. And so therein lies, going from 1,000 trades, getting rid of 100 really losing trades. And the 900 trades look a lot better, but then you've lost 100 of your sample size. So this is how I would think of it in terms of robustness. If you got rid of all your shorts or 2/3 of your shorts, then you're just hammering on the sample size. And then therein lies your road to figuring out how is my robustness going. I think if it's a reasonable rule, I don't think ipso facto, I have a rule, that means it's less robust. It really just means if I have a rule, how many trades am I avoiding? It's kind of like a 50-day breakout and a 100-day breakout. The 100-day breakout doesn't do as many trades as the 50-day. It avoids doing some trades. It avoids some losses. Is that less robust than the 50-day breakout? Well, yeah, but only because it does fewer trades. There's no funny business going on here. It's just that 100-day breakouts are better. It's probably a better system. It's a little bit longer term. So, but it has fewer trades to look at. So, but I definitely think that. And I don't know anything. It goes on to say, I think. I suppose I'm trying to explore ways of filtering trades with limited upside. Yeah, that's a good idea. I don't know how to do that either. Anyways, you're in the call, Seth. If you want to comment on all of this, go ahead.
Hey, thanks. Morning, everybody. I was just kind of wondering, as a general level of risk reward, what do you think is a good place to put that filter? Is it like 3 times the risk or 2 times the risk, or is it just I would guess with our win-loss ratio, somewhere around 3 or 4 times reward to risk is where you'd want to be. Do you have a general level that you use, Jerry, or is it just? And do you have a written rule, or is this more of a discretionary thing that you do?
Oh, I have a rule, and it's just in the code, right? So with 350 markets, I don't really have. I have to have a rule, and I've got traders, and I don't really do any discretion on the system side. So you have a rule, and the rule is simply based upon the backtest. So these shorts are pretty bad to begin with. Philosophically, let's talk about shorts. I've said that people have told me over the years you should trade a crappy system, maybe a system that doesn't make money, along with your long-term trend following, because this system overall doesn't really make money, is going to improve your smoothness and we're going to do things that improve our smoothness or our sharp inadvertently, but not more parameters, not more rules, but other things like adding markets and maybe, limiting these shorts. And so, and maybe trading poor systems. And so I just never wanted to trade a system that was uncorrelated to trend following, even though it may smooth out some of the bad periods of trend following. So I think that trading shorts is kind of my system. They don't really make much money, but they do help out sometimes. And they definitely help out on a daily basis with the risk. Longs and shorts are uncorrelated across the sectors. So I wouldn't be in favor. I think you'll get better performance numbers by getting rid of the shorts, but I wouldn't be in favor of that. So I think just simply doing a back test and optimizing and seeing where the some sort of break even might be of how many shorts you can get rid of before it starts to hurt on the equity side, on your daily volatility side. So I've talked to my friends about this before, and I would say, oh yeah, I have this short filter, and they would say, I have one too. And I'm like, well, here's my parameter. They said, that's my parameter too. And then I told them what I called this filter, and they said, that's what I call the filter too. So I think that if you do the back test and just go through a bunch of parameters on where to limit, where to say I'm not going to take a short if there's X amount of profit potential down to zero, then play around with those parameters some. I think it pops out at you. I don't think it's magic. There's just pros and cons. And I have had people, I think it was 2018 or 19, we didn't short a lot of stuff in 18 and 19. In 08, if you look at my performance in 08, it's kind of not that great as the industry was just crushing it. And but we missed a lot of shorts in the last half of the year. But in January, the markets rallied. Those trades never went anywhere. They kind of rallied, and we didn't have as bad a January. So our edge in that regard got transferred over to the next month. You know what I mean? So yeah, but so I would just do this back test, and I have people as well who at the end of 18, they had this relative performance that was really poor. And they swore off these things, said, I'm never going to do these things again. I'll take these low expectation trades because I just can't stand the relative performance differential. Sometimes these crappy shorts.
Because if all our logic shows that we need shorts, because as many of you said, Jerry said that, Neil said that, Richard said that we don't know the regime and environment of the future. And it can be anything. So, of course, we need short to be robust, to be a trend follower. So I fully agree with all of that.
Go ahead, Kadura.
I was asking. It's all related to volatility, right? Meaning that if you have like a possible big percentage drop, you won't take it if the ATR is too high, right? For example, in natural gas, etc. Even if it could be a major downtrend in percentage terms. If it's not in risk in ATR terms, you wouldn't take it, right?
Right. I mean, that's a very good example because I remember over the years there has been huge short trades in natural gas, and I trade 3 natural gases: UK, Dutch, US, And I was looking at those trades yesterday, and they have been monster downtrends for over the amount of they've been smooth, and they started months ago, not a year ago. And I never shorted those because the potential profit was so low. And you're sitting there with this trade, and the trend looks good. You're just not making any money. And it's a combination. I don't think it necessarily. And I look at a lot of markets in this regard, like daily. I look at these reports that show me what's going on in all the markets and their stats. And it doesn't have to be a huge increase in volatility. Alibaba is a stock that I look at every day, and it's been in a huge downtrend. And it's never going to have an ATR low enough for me. It just won't do it. It's embedded inside the market in some way, and for some reason, that some of these markets, it's just going to be difficult to get the shorts on. And so what essentially happens, is when you do this back test, and then you put in this filter and you're happy with it, and then you're like, okay, I've got my shorts taken care of. I got the filter. It's not too stringent. I'm good for it. Now I've got my systems all built. And then you do the back test and you get the results back. You essentially say, every time you run this back test, you're essentially saying, well, now I've got to decide how big am I going to trade? How many risk units am I going to put on? So then you may say, okay, I'm still going to do 5. I'm still going to have 5 risk units on, or whatever. Maybe when you see the back test with the shorts limited, the performance is a little bit better, so you can trade 5.5. And essentially, you're trading this risk budget, and you're putting this extra risk. It's not going to go into as many shorts. You're going to put it into the better trades now. So you're kind of shifting risk away from the shorts into the longs or the better shorts. And it really, to me, just boils down to I'm obsessed with this trade stats: average win, average loss, average trade, win percentage. And I'm going to give up a little bit on the equity stats as far as the volatility and the choppiness, because I want to maximize my trade stats. And the way to do that is, I'm not going to take some of these really crappy trades that on the short side that have limited. Now, I also have been guilty of doing that on the long side as well with the interest rates. And so as interest rates started approaching zero, we were limiting our long trades, and that famously did not work out well. And then rates went to negative. But I did absolutely tell myself, and anyone who would listen, rates can go negative. I'm not saying they can't go negative, and they did go negative. And some of my performance in 18 and 17 is, you can see it's way below industry standard, because I flipped it around and used that ATR filter on the long bonds. But so I would not recommend doing that. And and if you vol manage, this is another thing too. If you're volatility managing and you short something with 10 ATRs to 0, then go ahead and do that, right? Because then a week or two later, or a month or two later, now the vol has gone down and you can keep upping your position. So you can kind of keep increasing the position as the vol goes lower and lower, all the way through the trend, really. I think Absolute has talked about this, and he said that's a big edge. You don't have this issue. But if you're like me, 1 entry, 1 exit, stop loss, you have this one opportunity to go short. What's the vol? It's too high. Can't do it. I'm not going to keep adding to the trade. So probably the larger managed futures CTAs, this is why they shorted natural gas. I'm not smarter than they are. They short it and they continue adding to it as the vol I looked at that yesterday, the breakout, the downside breakout to nat gas. The original ATR was pretty high, and then it got lower and lower, and then you could slam on more, and then a trade, I guess, started looking a lot better in their terms. This is another limitation of 1 entry, 1 exit, and a stop loss. This binary approach, you don't get to add as the trend keeps going lower. And then, of course, sometimes as the trend goes lower and you keep adding, you just get destroyed with this big rally. Sorry.
No, there is a huge example of that, which is the VIX futures. VIX futures really, they get reduced and exposure very fast. So there you have to make a big decision about whether if you're ball targeting, you will be making very big positions when that contango ends up being realized. I was wondering if when the end concept was developed for the risk per trade, for the standardizing risk, and also for the usage of placing the stops on the trades, if that's especially the second one, using the number of ATRs, etc., was back tested, or was something like it was thought out of the box, so to speak, and then back tested?
I would say that when I did my first research, my conclusion was that the parameters that we were given were too short term. And then I asked them, why did you choose 2 ATRs? That is not an optimal level. It's too close. Your win percentage is low. You get whipsawed. Yeah, and their response was, "Oh, that was just our personal preference." So I was like, well, to myself, I was thinking, "Oh, I don't want to do anything that's a personal preference. I'm just going to do the back test and go with the numbers." So I think, and then 2 ATR stop loss back in that day, that was the max. And there were other rules that people followed where the stop loss was much smaller than 2 ATRs. So that was pretty brutal and crazy because, every time you buy at 100, you get in at 100, it goes to 105, then it goes 2 ATRs below 100, you got to get out. But then to get back in, you got to wait to 105, so you got a little bit of slippage every time you get back in sometimes. So that made it pretty brutal. So my stop is far away compared to that 2 ATR. But I think the whole concept of how that was all put together was probably something they came up with, and then they back tested the parameters. But I really don't know. I don't think I was told how they the sequence, the process they went through to come up with these systems.
Yeah, I was thinking that maybe it was an issue like a conservative point of view. Like I can be, I could withhold 2 days, 3 standard days in a row against me and not close the trade. The same way that maybe the risk per trade, as a percentage of the NAV of the assets, was also something like I can withstand some kind of some number of bad months and still be alive, something like that.
You got to remember, this was a strategy that was not built to trade to manage money, charge incentive fees, charge management fees. This was a strategy to take a little bit of money that you had and turn it into a lot of money. The goal was to make 200% a year, let's say, and we did make 200% a year. And so the stops were close, the trailing stop was close, the outlier was 20 ATRs, versus now for me it's probably 150 to 100 would be the top 10% trades for me. So it was like cut risk very quickly. Like I think one of the most important things to do as a trader, obviously, is to do all the trades, do all the system trades, right? So follow the rules to a T. And one of the ways that you can follow the rules to the T is to trade small and have looser pants, so you don't get into trouble with drawdowns so much. So we were always in trouble having drawdowns. We had special rules, cut back, and then get back in. So you were kind of not able to only do the system trades, one entry, one exit, and a stop loss. You were doing these money management, risk reduction trades, then risk addition trades, because you're just trying to trade as large as you could for as long as you could without going bust, and hit on these trends and then get out and take a profit when the trend reverses, a minor reversal. So it was a whole different ballgame than what people do now, what the large CTAs do now. In the short term, that sort of short-term turtle trading, I don't think works very well. And I think the short-term trading I like is the kind that Alp does with the hourly bars.
Hey Jerry, hey everyone else. In terms of shorting with the long-term systems, so if you're breaking the system there, all right, so you're getting out of the system, and this is causing you some sample size, this is causing you some profitability, this is causing you some edge. So what you can do conceptually is you got few options. If you're gonna break it, you have to break it right, okay? And you can be creative from that moment onwards in your system design. So one of the things that you could do is you can increase the number of short markets. So if you're gonna put a filter on, but if you actually increase the number of short markets, then the total sample size is not going to be that different from when you compare it without a filter. So increasing the number of markets will help you out. So that's one suggestion. The second suggestion would be you will be losing some money there, of course. So using a shorter term system is going to help out. So that would be the second thing. So instead of using a 100-day breakout, why don't you use a 60-day breakout, for instance? Then your ATR multiple is going to be smaller for shorts, and those shorts are going to be more meaningful. So that would be another alternative. Or really, as you have said, for shorts only, go to the dark side, apply the dynamic position sizing. So whenever volatility goes down, you put on a new trade. So that's probably another suggestion. Or another one would be just do old-fashioned pyramiding up. As the price moves into your favor, put another position size. And if you're uncomfortable with the number of the amount of position size, you can always increase the universe of short markets, so that your total your position size per market is not going to be too much. Especially this is very easy to achieve if you're trading single name equities. If you're shorting bank stocks, and in that particular bank stock, okay, if you have a downside, let's say, just 2 risk units and you don't want to be taking, then what you have to do is then you're gonna short all the industry. You're gonna short all the banks, and if you can catch multiple 2 risk units, then it's going to make some money there. So the increasing the trade frequency is definitely going to give some edge without increasing the position size, or you're going to increase the position size. So you could be really go very creative about it. And I don't think that long-term systems in any way are limited in terms of taking the short. It's just you have to follow slightly different methodology that will suit you to help you out, really, if it makes sense. Thank you.
Well, I mean, I'm happy with this filter approach, because it's like sort of saying, like, if you talk to someone who's not a trend follower and you're like, well, where did you get long the bonds? And you're like, I got long bonds this week. And they're like, wow, I mean, I got long bonds near the lows like a month ago. And they're like, oh, you really missed out. And you're like, well, no, I didn't. I mean, yeah, I waited for it to rally, and it rallied pretty good, and I had a drawdown, and I waited. This is what trend following kind of does. You can't judge me by waiting until my edge to following a system that's going to wait for a while and buy after a big rally. This is me implementing my edge. And in the same way, where did you short nat gas? Well, I didn't short nat gas. Well, you're going to miss a big trend. Well, no, I'm not going to miss a big trend. That's why I didn't short it. And it's just part of my rules. And when you look at all of these rules, this is the definition of my edge. And so I'm just following. I have one extra little rule in there, and yeah, I'm just following that. So I really don't see where this is very controversial. Like I said, I try to dream up, you know. Okay, I do remember 2 or 3 times where for a month I relatively underperformed because I didn't have a lot of bad small shorts on. Like all the commodities went down 4 ATRs, 4 times 50. You know, I got 50 commodities or whatever, 4 times 20 or 30. They all went down 4 or 5 ATRs in 1 month. I underperformed. But then the next month, they all rallied. They never turned out to be good trades. And I had relatively good performance. So I don't know. I'm not going to stress over that. Yeah. So I've talked about this. I've thought about this subject a lot, of course, over the years. But another thing, too, that I think Al brought up, I think he was talking about indices. And that's another thing, too. If you package together all your stocks into an index and you say, well, I think it's definitely kind of possible to get vastly different results. So if you wanted to short the S&P stocks individually, probably a lot of them would be not have enough ATRs based upon your filter to go short. You would say, okay, man, I'm not only going to be able to short maybe half of these or a third of these because the ATR are very high. And then if you looked at the S&P index, though, of those same 500 stocks, you could easily short it because the ATR as related as a percentage of the price is much lower. So you can't short the individual ones, but you can short the index. Now, to me, that's stupid and goofy. And I'm like, wait a second. I don't want to be a part of something so stupid. I hate these indices. It's another reason to dislike them because it's a game and it's not legit and real. Some of the shorting and going long a lot of individual equities is wonderful because you're getting into them all at different times. They have their own trends, their own fundamentals, their own ways of adding diversification to your portfolio, and trading them as one index is really inferior. So, and what happens with this is that when we take the price and we compare it to the ATR, and we're like, okay, it's low enough or it's not low enough, so I'm going to do the trade or not do the trade. But with the index, and so we do it on a case-by-case basis, but what the index does is it not only part of the ATR calculation is influenced by the correlation of those stocks. So we don't look at our portfolio and say, oh, I'm going to trade these stocks bigger because the correlation is low. Well, we kind of do that, but then we make the sizing of each trade independent. So it's a 2-step process. Here's the sizing. Here's my total units based upon my backtest and the correlations and the volatility. Whereas the index says, I'm going to just make that one big process. I'm going to look at all these stocks together. They're all correlated. The ATR is being driven lower because of this correlation. And then I'm going to have this artificially low ATR, then I'm going to do this trade, which you could do also inside your portfolio, but no one would really do that or want to do that. But you kind of do it and get away with it. You kind of convince yourself, oh, it's the thing to do because I'm trading an index, which I'm sure no one understood what I'm trying to say. Sorry about that.
I was just wondering how Alibaba didn't qualify for your short filter rule. Just curious.
Well, simply, it's not going to qualify depending upon where I set that parameter, like how many ATRs do I need to have in a trade. And so the price divided by ATR was, for my taste, too low. Now, for you, it could be okay because you could choose a parameter, price divided by ATR, that's lower than mine.
So
mine, yeah. So it's just simply that it never, the ATR never got low. I mean, sometimes they do. You can imagine it's like, let's say the breakout is in January. You go short in January at the breakout. I might actually do the trade in March because it's taking 2 months for the ATR to get low enough. And so I'm delaying that trade until that ATR gets low enough. So, or I may never do it. And with Alibaba, I just never did it. And sometimes when you set your parameter, when I set my parameters and I'm following it, I will not do the short in January. I will do it in February or March, let's say. It's going to take a while for me for this, if this ATR gets low enough. And it got low enough on one day. So then I'm like, bingo, go short. It hit my parameter level. Then the next days, I wouldn't have done it. I wouldn't have done it before. I wouldn't have done it after. It was one day that I came in where the price divided by ATR was low enough to high enough to fit my parameter. So just inside baseball.
So what's your look back? Because my ATR is, I think on the Thinkorswim, the standard look back or the default look back is like 14 days, and it's showing that the ATR on mine is like I think it's $2, and it's not in percentages. I think it's in $2. So are you using a longer look back or a shorter look back for your ATR calculation?
I don't think that my look back is going to have much to do with it. The length of the look back. Yeah, I'm showing. Yeah. So what are you showing? Like $2? Is that what you said?
Yes, sir. Let me make sure it's $2.08. And I think this is with like a 14-day look back. I don't think I changed the setting.
You're right. So $72 divided by 2, it's too low for me. That's all.
And what did you say your cutoff was? I forgot.
Oh, I'm not going to tell you my cutoff.
Okay, I got you. You got to have some secret sauce. You can't give it all away.
Well, I know. It's just like I want you to find the joy in doing that research and finding that parameter and finding the one that suits you. And then when you come up with your parameter, direct message me and I'll tell you what mine is. See if you came up with something larger or smaller, But
Well, I mean, it looks really good for a short. Everybody hates the Chinese stocks, and I know that you guys don't really care about narratives or any of that stuff. But I like Baba, but it's just you can't
well,
argue
yeah.
with the
I
fact
mean,
that it's in a downtrend.
yeah, it looks good, but I mean, it's all for me. It's just all about the system and the numbers, and
Right.
yeah, I don't care about the narrative. But it's been a good short. It definitely would have been. But this is another thing about trading, especially systematic trend, is back that original breakout in May of 21, $93 or something. That original. Well, there's multiple breakouts, of course, but back in May of 21, $200 around there, shorting it. Yeah, that's been a good systematic trend. Is and I've said this a million times. If you take this wonderful filter, short filter, filtering out shorts, if you take this wonderful filter, you will find trades like many trades like Alibaba where it's kind of failed. Hey, that was a decent trend. I'll take that money. It's been going on for a long time, and it's not a bad trend. But with systematic trend following, you add in all of those trades. So you've got the few that were pretty decent, Alibaba being one of them, and then you've got all the other ones that you have to throw in there as well and sum them all up. And then taking those trades is kind of a negative expectation, probably, in my opinion. Yeah, so it's not just cherry picking Alibaba and saying, I found one where your filter didn't do that well. And you're like, oh, sure. Oh, yeah, of course. You can find them on the long side as well. But you add in all of those trades that filter avoided, you're going to be much better off transferring those risk units essentially into higher expectation trades.
Jerry, and speaking of shorts, I know that you're a long-term trader, so maybe the big futures don't make that much sense. But do you treat that one as just another future, or do you take any special treatment, don't trade it at all, etc.? Because that's a short-term short most of the time, of course, with the huge surprises in the long side. But Do you take that as just another one future?
Well, I have the VIX in my on my trade sheet so I do trade it. I now I think on this one, pretty sure that thankfully we've been filtered out of the shorts. Oh, and I hear people talk about shorting the VIX on podcast, and it makes me wince a little bit because I'm not, I'm a little afraid of short VIX. I have short equities, of course, and longs, but I'm glad I don't have. I'm not saying I'll never have a position in it because we just follow the rules, follow the system, and if it was a short in our system, we would take it. Now, this is not the first time I've told you my strategy on VIX, though. My strategy is I'll buy the breakout and get out if it gets to 80. And I just picked up that number from Wayne. I should check in with Wayne every now and then to make sure he still thinks 80. I did hear him on a podcast once say VIX cannot really sustain prices above 80. So I would trade the VIX purely discretionary, essentially, and just I'd be watching it and saying, okay, 60, now we're at 70, let's take some off. And then it goes to 75, I'll take some more off. And then if it gets to 80, I'll go flat. So that's my VIX strategy. So I haven't done a trade in VIX. I don't think, since I put it on the trade sheet, I don't think I know if I've done a trade in it. I don't remember having done a VIX trade. So I haven't had that opportunity. So back in December, let's see, when it peaked out, March of 2020, I don't think I was long back then.
No, and as you said, it must be a very bad ATR to downside opportunity ratio, right? Because it's so volatile.
Right. I mean, the volatility I'm looking at today, right now, it's low as it's ever been. But so is the price, I can't, for some reason, I can't find the futures. I'm looking at the cash. But yeah, some of these markets, I think they just inherently, I try to run research, especially as it relates to stocks, to try to identify characteristics. Are there characteristics of stocks that will give me a more likelihood of being able to do a short? So yeah, that's what I'm trying to. Are there certain stocks where the price divided by ATR is usually going to be a higher number, and that's something because I want to put these shorts on. I just don't want to put crappy ones on.
By the way, I was reading another thing about shorts that it has something to do with shorts and trend following, but not about trends. But there is an AQR paper that speaks about the use of cash in derivatives strategies, etc., and how those strategies behave in long term or short term, high rates or short rates periods. And what the guys at AQR said is that shorts are useful to compensate for the cost of longs when you are using leverage, right? Meaning that most of the time markets are in contango, and so there is an implied interest rate there when you are going long. So shorts, what they said is that shorts help you. I know it's a minor effect, but shorts helps you compensate that cost because when you're short, they say you're earning that interest rate that you're paying when you're long. It's a new paper that they published the other day, and it also says that trend following actually works better when interest rates are high, contrary to what equities and bonds do.
Yeah, I'm not surprised with that. I mean, I think that rates being high are a function of inflation, probably, as we've seen in my lifetime, anyways. Rates and inflation, and so we get inflation, we get markets moving around, especially moving around on the long side. And there's been many years where you're kind of like not in trouble, but you're kind of like in a less than optimal situation where most of your trades are shorts. And I've been in those situations many times where most of the positions we had on were shorts. And so you're like, okay, hopefully we'll make a little bit of money, but getting long commodities is really probably where all the money's going to be made. I don't know if any of you guys listen to Andrew Beer, now kind of a regular with Niels, which is what a change that is, right? We got this replicator who people didn't really like, managed futures really didn't like so much, replicating their performance in his stated edge being just not charging the fees that SocGen and CTAs charge. And now Andrew's a regular guest. So I like this podcast. I like to listen to Andrew whenever I can. And I think, and he was kind of giving the business to these large firms that are coming into the ETF space with their trend following, but making sure that they don't compete too much with their other products that charge incentive fees. I thought that was kind of funny. Not really sure how you're gonna make a lot of headway in a space with a sort of a watered down product. And Neil said that Neil was getting me confused. I don't know if he thought that Andrew's fund was watered down, or I guess it is sort of watered down to some degree. It's not all the full, all the trades that the SocGen trades do. It's just a replication of using 14 markets. But certainly these larger firms coming into the ETF space to sort of head off any sort of massive assets that are going to be raised by ETFs that want to get their fair share. They're going to on purpose put in what they would consider to be inferior trading to their funds that charge higher fees. So I think we'll watch that over the coming years to see how well they do in that regard. I'll do everything in my power to hopefully help them not be successful as compared to what we do, which is give everybody 350 markets and our best ideas. We don't want to hold back anything.
Hi guys, is there any justification for them reasonable justification for them to run this watered down strategies?
Well, they charge lower fees. So now another thing that kind of goes in with this was another one of my favorite podcasts, and I tweeted this a few times. The guy from CFM was on Niels's CTA series, which I totally loved. I love CFM. They're trend followers, plus they do a lot of other things. But one of their papers, one of the guys who Niels interviewed, he said, look, basically we did a study. We've concluded that CTA's performance is pretty much all due to trend following. However, the managed futures, they want to, and this is sort of probably like their version of trend following, which has dynamic position sizing and maybe other stuff that wouldn't be right to fall into the category of dynamic position sizing. But it also would have things like carry, short-term, pattern recognition, counter trend, things like that. And he's basically saying that none of that stuff really adds any value. It's just all about trend following. So they add this other stuff, I suppose, to smooth things out and to make it seem more complicated, so in order to charge the incentive fee. But then they want to get involved in the mutual funds and ETFs as well, because they're not satisfied with the little crumbs that they've left everyone else, that they want those crumbs as well. So then they get into the ETF mutual fund business with the trend following only, and that's sort of watered down. So, and I'm like, oh, darn, that's all I do is trend following only. So that's all I have is a sort of their version of watered down. And so it gets a little complicated when they say that, well, we're going to charge a fixed fee, but it's only our watered down, which is only our trend following. And then the paper comes out and says, well, that's the only thing CTAs really offer is the trend following. And so a couple of weeks ago when Niels and Alan were talking, they were pushing back on that, that's not true. But I think it kind of, I sort of stick with what the guy at CFM said, which is basically that CTA implementation of things other than trend following doesn't seem to add a lot of value, even though that's what's used to justify the higher fees. Does that make sense?
Yeah, you got me laughing here. It's like they're offering something that only takes the worst part out, and they call it watered down. And no, I mean,
It would be, I would have a lot of respect. Well, maybe no respect actually, but maybe you could say, oh, I'd have a lot of respect if they took out the trend following and just gave me the stuff that doesn't really matter. They're like, oh no, this is demonstrably the worst product because it's short term, carry, mean reversion, whatever, all the non-trend following stuff. But the core of the trend, which is what really drives all of our profits, but they do the opposite. They give you the core that makes all the money, and then they say, okay, we'll only charge you a fixed fee. So it's really a good idea. Although also, I think on this last ETF that just came to the market from NAHL, oh yeah, this was unfortunate. They only trade 20 markets. So they probably trade hundreds and hundreds of markets in their other funds, the private funds and managed accounts they do for institutions. They probably trade hundreds of markets. So that's another way too. We will only do the trend following. But if we only do the trend following on the hundreds of markets in our ETF, the performance is going to be too good. We've got to find a way to sabotage this thing. You don't want to come into a meeting with all the crew and someone say, our top performer is the ETF, where we charge 100 basis points. And we have a bunch of people on the phone wanting to know why we're charging an incentive fee.
Okay, but now that's more reasonable. I mean, perhaps you need a larger team to run these markets that are harder to access, that perhaps they do with a larger fund that they wouldn't be able to do with the ETF. I don't know, but I don't know if it's exclusively a price discrimination argument. That it's kind of poor, isn't it? I mean, oh, just because I'm doing the worst version of it, I'm charging you less. I don't know. Doesn't sound very good.
And really the way it works, is in the morning, they run they run these computers and for me, this is how I would do it. This is how I've done things in the past. So I would have different funds and different managed accounts, bespoke solutions for certain clients, right? And we look at our trades and we say, okay, the system, I'm going to trade. I'm not going to on purpose choose worse systems, right? So if I have some clients that don't pay as much as other clients, I'm not going to choose a worse system, a group of systems for these clients, for God's sakes. I'm not going to do that, am I? And then, so we get this buy, in 10 years, and we just, the computer tallies up how many total we have to buy, and then it allocates them across all the different accounts at the same time. So there is no extra work. There's no extra work. We have a fund that trades hundreds and hundreds of markets. That takes a lot of work. And then but then when we do those same trades for clients that don't pay us as much money, we just allocate it with our allocation program. And this is not I have these extra people because I need them to run the more complicated stuff, but the less complicated stuff, it just gets the same allocation that the complicated stuff gets. So there is no reason to have this idea that they're charging more because theoretically the performance is better. Maybe it's better. Yeah, it's more consistent, less volatile. Hopefully you don't choose worse strategies for your clients, worse trading systems. I can't imagine someone doing that.
I mean, I'm curious. Richard is having these new sets of podcasts. Now, Richard, do you have any new learnings from you're talking with these people who actually run multiple strategies? They add strategies over and above trend to smooth out their equity curves and to make the journey a little bit more palatable. Um, do you have any new learnings, new observations that you can share with us? Uh, given your new experiences with the podcast. Thank you.
Alp, it's only made me more committed to classic trend following. There's a big cynic in me, which is looking at this shift away from performance fees to simple sort of ongoing management fees on the basis that AUM of these funds is significantly increasing because they're offering a smooth ride, but they're not offering absolute returns. So you can see why there's less demand for performance fees for those smoother funds that aren't offering absolute returns, because they're getting their enhanced fees through significantly increased AUM because it's more palatable for investors. And with that comes a compensation of the management fees, which is obviously doing them very well. So there's no real incentive on their need to have these performance fees. But for someone like the classic trend followers, like Mulvaney, like Jerry, etc., the performance fees is where the people with skin in the game actually get the benefits of their very strong performance with their uplift of their equity curve. And, if for instance, one particular year they can offer a 50% return because it's a glorious trend following period, but it might have been 5 years to reach that stage, I think they demand to be rewarded for that because they're offering these higher absolute returns. Smoothness to me is a game we can all do. All we need to do is get these very sort of weak, non-challenging systems, uncorrelated systems, bundle them together, and hey presto, we've got a smooth return. That's sort of, but that's not the game. I'm excited about, and the more people we have on the podcast, of course, that Simon and I in the Algo Advantage, we're having Jerry on next week, which is going to be very exciting. Looking forward to that. But having this appreciation of what other people are doing, I'm always interested in that. But what it's actually doing to me is making me more sort of understanding of how successful our classic trend following process is. And it's just making me more and more committed to it as the days go by. As people are explaining these different approaches, mean reversion, all of these things, all I see are these big negative skew events in these processes. So, you can't be rude on these podcasts. You've got to entertain everyone's viewpoints, but it doesn't necessarily mean I agree with them. And I'm not the sort of fellow who comes out aggressively and shouts down different people's approaches, but it just makes me very happy with what I'm doing.
Actually, when I look into what you said, I actually slightly disagree in the sense that, because first of all, I'm a prop trader, all right? So I'm going considerably higher returns than 20% per year. My expectations are higher. That's what I do for a living. So I'm not in the business of sales alpha. Okay, I'm in the business of trading alpha. So when I look into it, I'm looking into the traders who are making 40% over the long term. And that's the kind of where I am in my second year. So I'm not trying to sell this. Okay, sales alpha is completely different animal. No, but if you're talking about sales alpha, then all the strategies that you have mentioned is actually able to come up with returns that can compete with S&P 500. And the game of sales alpha is to be able to come up with a product that competes with S&P 500. So S&P 500 gives you this 8% and 50% drawdown. Then to be able to sell this thing to people who do not have expertise, skills in managing these portfolios. So the question is, how are you going to sell this? And actually, I'm in favor of to be able to sell this. I think the smart thing to do is to use multiple uncorrelated strategies. You know, because you're competing with 8%. You know, if you can get to a 12%, 15%, how are you going to get it? You know, you can get it there with pairs trading. You can get it there with relative momentum. You can get it there with, you know, with the pattern trading. And I'm all talking systematic, all right? Nothing discretionary, all hard coded stuff. So, you know, there are hundreds of different ways of coding it. And when you actually have a diversified sets of strategies, you can sell this thing better. And I think, you know, that's very important. So what is the game? Are you going for sales alpha or are you going for trading alpha? Well, if it is sales alpha, yeah, you know, that's I don't know. I'm not quite sure whether you will agree. I'm sure you won't. I don't think that Jerry won't either. But you know, you know, I think there's a huge value in combining it so that you can sell it better to the people who don't have a special skill set. This doesn't mean that the trends don't work, but trends are, you know, the long-term trends are not just um, great great products to compete with S&P 500. Why don't you just, you know, just check it in 4 or 5 strategies, you know, come up with something else that is going to compete with S&P 500. You know, we're talking about 12%, 13%, really, really low leverage, you know, products that are fully regulated. You know, it's just for the purposes of sales alpha, you know. It all makes sense to me. So I think the people that you're talking there, Richard, is a very good example for me in terms of how to diversify, how to get those smoother returns, so you can make something else out of it. I mean, we keep on talking about trends, and I'm loving it because this is what I'm going at. Thanks.
Yeah, look, there's a couple of things you raise there which I'd like to bring up. Firstly, the prop environment for trend following is, to me, it's something that I totally shy away from, because the demands placed by the prop firm on this consistent level of returns generated by the strategy means that the particular strategy that I focus on, classic trend following, doesn't meet those hurdles. And so therefore the demands placed on by the prop trading environment ensures that I will have to incorporate mean reversion into my strategies, all of these different aspects which smooth my returns, deliver their benchmarks, but it's not achieving absolute returns. The second thing is that when I'm looking at the long-term track record of the best fund managers in the world, they're all converging to the ones that I'm focusing on with the performance returns that I do for Niels every month. And we can see that the survival rate of the firms that are offering these, demands of 40% per year or whatever, they're non-existent in the long-term track record, and it's not a sustainable proposition. So I'm really focused on those strategies that are robust over many different forms of regime, and the only particular strategy that I can see holds merit and has a large number of funds that adapt that principle or adopt that principle, as opposed to maybe the handful like the Warren Buffett or the Soros or whatever, who are spectacular in their own right, but they're not being sort of represented by a large number of other funds doing the same thing that they're doing. For the large bundle of funds that I see that can have this valid track record over 30, 40 years, the only ones I'm seeing pop up are the trend following funds. So that to me immediately raises a red flag with alternate strategies that certainly can be successful over particular regimes. But to have a career in those particular opportunities, I think the track record demonstrates that that's a pretty far-fetched proposition. And yeah, so I've got a lot of concerns that were raised there. Particularly the prop industry. The beneficiaries of the prop firms are the owners of the prop firms, because the people that they pass through their ranks deliver all of these uncorrelated strategies. So yes, the prop firm itself does well, but they've got a legacy of failed traders coming out of them who just get dropped at the drop of a hat when they just don't happen to perform, and these prop firms are unlikely to support them over periods where they're not performing well. And it's sort of like a churn and burn process where the only people doing well out of that are the owners who have equity in that prop firm.
Yes, I agree. I think when I use the prop traders, when I said I'm a prop trader, I meant to say I'm a trader who goes for the absolute returns. Yes, I totally agree with your definition there. But when it comes to the sales alpha, looking into the history is not going to be very much helpful in my opinion, because algorithmic trader is here, okay? So the algorithmic trader is the ability to come up with these quantified strategies. And looking into the 30 years ago is just not going to be very helpful, because at the moment, when I look into the Quantpedia, for instance, where I look to, I like to do my research from there. There are many strategies that work, and there is nothing wrong with doing relative momentum just a little bit. It's slightly uncorrelated, or slightly doing something else pattern based. And when you add these bits and pieces into your portfolio, what you're going to do is, when you're going, because the objective is to compete with the S&P 500, right? So S&P gives you 8%, so you have to come up with somewhere else between 12% to 15%. If you can get there, well, you're going to sell this thing. You're not trying to make money from absolute returns when you're trying to sell this. So we are talking about sales alpha here. So for the purposes of sales alpha, your expectation is really low, and for me, anything else, and there are some managers, I'm listening, Eric Crittenden. He he loves to talk about single digit returns, and he has a jargon, He says high single digit returns. Okay, he loves to talk about his high single digit returns. So he loves to talk about this 8% and 9%, and he has a drawdown, but there are people who actually competing S&P 500. So 12% is a lot of return when you're comparing yourself with S&P 500. So when you're talking about absolute returns, that's another game. So that's a trading off. So I'm not talking about that game, but so the question is, what is the best way to sell this? And I think what you're doing in this algorithmic trading podcast is excellent, because those are the way to sell this. So I'm all in it, and I would be very keen to learn your experiences of how people are coming smarter ways of selling it. Thanks.
Yeah, no, Alp, I agree with what you're saying. There's a business of investment or fund management, and there's the game that we're playing as traders in trying to deliver these absolute returns. Now, the business of investment and trading, yes, I do respect the fact that they're able to attract these significant levels of AUM on single-digit returns. There's no question about it. That's smooth returns, etc. But that's not the game that excites me. So I do sort of avoid that. But it doesn't mean I don't respect them. Of course I do. And they've got their particular objectives, but it's not the same objectives that I'm trying to achieve in this game.
I love that term, sales alpha. I love that. That's pretty cool. Yep, I agree with all of that. I mean, I do think, though, that maximizing your strategy, making it as great as it can be with trading a lot more markets, definitely trend followers should trade stocks. And start there. I would just try to do everything that I could possibly do to make what I do better. And then before I launch into some sort of negative skew strategy, So I do think, so once you start trading the equities, and that's a material part of what you do in your trend following, then if you still have issues, then maybe I agree you need to, but there's so many other things you can do. One is to talk like large managed futures CTAs talk, with their science and their math and and speak the language of Sharp and all that stuff if you can stomach it. I would prefer to kind of like talk about crap rather than adding crap to my system. So if you can kind of fudge a little bit and don't be so transparent, I think that's another great thing. it's a little bit secretive. I can't really tell you how I do it. And then you just describe all this stuff that maybe you do it, maybe you don't. We talk to people sometimes who have podcasts and they interview people and they ask them questions and they avoid the answer. Then off camera or when the microphone is off, they sort of say, well, here's how I kind of do it, and there's not much there, But they're raising lots of money because their sales alpha talk speak is a lot better than mine, or it's really good. And I think you really hit on another really good idea, and that is Eric. Eric and Abby, they have futures funds. Abby has a futures fund. It's very large with a lot of good CTAs in it. And they have another one with a lot of good CTAs, plus a long exposure to stocks like the S&P all the time. Eric he has one program which is 50% long equities all the time and 50% his managed futures program, trend following. Now, I think these are really good ideas. And every CTA in the world, since they ever began, could have done the exact same thing. Buried that in there, not talk about it so much, but put it in the portfolio at whatever percentage they wanted. None of them have really done it. And the people who do it, it's a marketing thing. They talk about it. It's one-stop shopping. You can put your money in this fund. You're going to get your stocks. You're going to get your futures, return stacking bonds, return stacking stocks, return stacking with stocks and bonds. There's 3 new ones that came out. I like those a lot. These are all really good ideas. And it really doesn't corrupt and contaminate your trend following. It's just transparently giving people something that they want to invest in and maybe making it a little bit easier to get clients. But as we've said many times, the bar is so low for trend following. For trend following currencies, commodities, stocks, bonds, long and short, the S&P makes about 8% with a 50% plus drawdown. So it's almost very difficult to impossible for trend following, the way I just described it, to be as bad as that. So I think trading small, lower volatility, not scaring people, high single digit. That's another really good idea. Then with some equities, with some equity exposure, it's going to over time be better than the S&P, but also absolute return and risk adjusted. But it is going. You are going to be unfairly judged when it has this temporary underperformance. To equities, people are going to say, why don't I have all my money in equities? They're never going to say, why don't I have all my money in the trend following fund? Never, not even in 2022. They're going to liquidate their allocation to CTAs got too high in 2022. And at the end of the year, they're going to liquidate some of that and rebalance the portfolio into more stocks and bonds, which ironically has worked pretty well this year. So I like your ideas, Alp, and I think it's a really good way of thinking. But I think I laid out a lot of options here prior to launching into negative skew, unless you want to classify a permanent long position in S&P or long stocks as negative skew. But yeah, be secret. Don't tell people everything that you're doing. Talk like they want to hear you talk. Oh, then they're going to ask you to do vol management. Oh, crap. Yeah, I couldn't do that either.
And Jerry, most of the time people compares the S&P, which was by far the best index of all. If you compare it to something international or to other countries, trend following will stand much better.
True, but I think the S&P overperformance of typical trend followers, that is I don't think that's going to be something to rely upon that I would want to rely upon in the future. I don't think I'm going to rely upon S&P returning, or, well, for God's sake, 60-40, returning to be a meaningful competitor to a fully diversified trend following. I think that it had its 10-year period or whatever, and now that's probably not going to occur again. It's a total fluke. I can't imagine betting against currencies, commodities, stocks, bonds, long and short, with trend following, taking small losses, letting profits run with the trailing stop and a stop loss. Can't imagine.
I mean, I was just thinking in terms of the, the next year. Now, what happened in my portfolio is the credit and equity has rallied at the same time, which got me worried a little bit. These long bond positions started to make money, and the equity positions are make money at the same time. I mean, have you ever experienced any period like this, Jerry? Because these things supposedly a little bit uncorrelated. So, one of them is going to give away. So what I'm thinking is either equities are just going to, boom, bang, crash next month, or credit. I cannot imagine a world where those two instruments, those two markets, asset types are actually making are trending at the same time. What are your thoughts on that? Thank you.
Well, I mean, I'm not an expert, and I really don't pay attention. My trade, I don't let these type of ideas influence my trading. But I mean, I think it just makes sense that when the interest rate environment is favorable, it's going to be a good thing for equities. And that's certainly when I got interested in markets in the 70s. That's exactly what happened. And on the downside for equities and on the upside for equities. And I think that will kind of probably continue. I think the same fundamentals. I don't really believe in the bond market saying one thing and the stock market is saying something else. The same fundamentals are flowing through all of humanity, and people are being influenced by them. Now, there could be some sort of delay, I suppose, in that the markets might start recovering prior to rates, recovering. But the expectation is that probably more important of what people are thinking. There's probably could be some delay in looking at the numbers and the charts and the trends. But I think that forever we'll have this correlation, which is fine because there is some benefit to trading, to having 40% of your assets in something that's a little bit different, and it has a lot less volatility. But the 40% piece is going to be very helpful when stocks crash. So when you get a stock crash, you're going to have flight to quality. And I know someone's going to bring up the last crash we had. The flight to quality wasn't there. Yeah, that's right. It wasn't really there, was it? But I think that's something that we should probably expect most of the time. That when we need it the most, when stocks have this dramatic sell-off quickly, the bonds will probably rally due to this flight to quality. So I think it doesn't really matter that they're sort of correlated. They're not 100% correlated, and having money in bonds does serve some sort of purpose, I guess. But as I said before, when I first got into the business, the marketing material that everyone had, the CTAs, would show the past 20 years performance or recent performance of trend following compared to the S&P, and our returns were always higher, and the volatility was always lower. Because look, we trade all these different markets. Is something superior inherently about equities? I don't think so. They don't have better trends, more often, more frequent trends, larger trends. No, they're just one of 4 or 5 sectors, and you should trade them. And then Corey posted a paper on Twitter a few weeks ago showing that maybe the analysis that there's an equity premium is all wrong. And there really is not much of an equity premium, if any. Okay, whatever. Is trend following inferior to buy and hold? You know, we can only trade commodities, currencies with trend following. They don't have this upward bias like stocks and bonds have historically or recent history. So is trend following inferior to than buy and hold in stocks and bonds? I don't think so. Certainly, we had great evidence last year about bonds. You don't want to be long bonds at all. You want to be short. You don't want to be flat bonds. You want to be short bonds. And now, I think same with equities. There are V tops and V bottoms where trend following, quote unquote, fails dramatically as it relates to buy and hold. As soon as we get short in 2020, the markets rally, and that's happened a lot over the past 10, 20 years, or 10 years. And so is this going to continue to happen? I wouldn't recommend your stock trading be exclusively in indices, 20-some indices. Branch out, find more diversification, more chart patterns, price patterns in the individual names. That's probably going to enhance your the performance of your trend following equities. So the odds are tremendously in favor of trend following all of the markets. And it's just going to come in time where CTA diversified trend following is the preferred investment. I firmly believe that. I mean, I don't think there's any doubt, that people will be heavily influenced by performance. And one thing that trend following does, two things trend following gives you is lots of volatility, letting those profits run, and accepting drawdowns. And for me, I have as much or more diversification than almost all the trend followers or traders out there. And if you're letting profits run, well, you can see in sometimes like November, December, you get punished by having loose pants. Alrighty, I'm going to call it a session and start my work day a little ahead of schedule today. But I appreciate everybody being here. Hope you guys have a good weekend, and we'll see you.